question around, are you worried about a stock market crash? Now, go back to the China pre-crash. You could have said to us, are you worried about a Chinese crash? Based on, Western capital leaving because it's afraid of tariffs and da-da-da-da-da. And I could have said yes, and yet still been invested into what we're invested into and not given a shit about it, which transpired as the best thing to do. So coming back to your question, are we worried about a stock market crash? Yeah, maybe, sort of. I don't give it too much thought because I'm not invested in the quote-unquote stock market for it to worry me.
You're watching Capital Cause, and my name is Danny, and today's guest is Chris McIntosh and Brad McFadden by way of Capitalist Exploits. Guys, thanks to you for coming back on the show.
Thanks, Danny. Good to be here.
All right, well, let's just dive right in, guys. What is top of the radar for you? What is the top story that you guys are, concerned with at the moment? Let's take it off with Chris first. Chris, what's top of the radar for you?
I'm not sure that there's one topic that's top of the radar. I think there's a few that are vying for a feature in the top category. On the one side, we've got increasingly geopolitical tensions. You've got the tensions in between Palestine and Israel are not letting up despite a ceasefire, and Trump coming in saying we're basically going to torch you as soon as I get into power. And then at the same time, you've got an attempted CIA coup in Georgia, trying to encircle Russia again. So we've got that, and then of course we've got South Korean politics, where they there's a I don't know if it's a coup, but basically they've got a whole lot of issues there. So we're seeing this across the board, right? Is this political, both domestic political upheaval, which is always it's always negative for sentiment in the market. And then at the same time, you've got international conflict that is ramping up across multiple jurisdictions. So in that environment, what I think is important, at least when I look at it, is that your geographies matter to some degree. Like your hunt for safety in an environment that is clearly more risky than the one that we've been in before becomes paramount for most money managers and individuals alike, right? When everything's hunky-dory, that's when you're running out there trying to make a whole lot of money and the sun's shining and everybody's happy. It's when you feel free to spend, it feels free to explore and to deploy capital. On the other hand, when you're fearful is when you retrace and when you look for safety. But this is a different sort of safety. I think it's a safety it's jurisdictional in respect, as well as sector oriented. And so, as Brad mentioned before we jumped on the call, like there's not much that we've changed in terms of our allocations in the portfolio. We're still very focused on essentially Maslow's hierarchy of needs, with a center on energy. And then at the same time, if I look, like Brad, we were talking about this the other day, our best performing jurisdiction for the last year and a half, at least, I guess now, has been Argentina. And so again, when you come back and you think about that whole geopolitical environment, like where is it that is geographically removed from all of the chaos? And then the second part of that equation, which is one which we delve into a lot, which is asymmetry. And asymmetry is two things. One is upside and the other is relatively low downside. Argentina had relatively low downside because it was priced for bankruptcy. So there's a whole lot of factors that are driving capital around the world. And so that's one we could talk about, is Argentina. It's performed exceptionally well. We had to wait for about 2 years. We're often too early. But in those 2 years, it didn't lose us any money. It just sort of sat there and, stared us in the face every day. And then all of a sudden, it was up anywhere from sort of 5 to 10 times, depending on the equity that we bought. And the interesting part is that it's still cheap on a relative basis when you contrast. I mean, if you just look at YPF as an example, it's still relative to Shell and Total and these things. It's still a cheap company, and yet there's a whole lot of upside in terms of expansion of existing resources. So where you've got shale in the US, for example, a lot of these companies have tapped out all their top tier assets. We've talked about this for a long time now, is that the tier one assets have been used. That's not the same case with a company like YPF, which owns what's about 40% of Vaca Muerta, which is that large shale deposit. That thing's running at 14% capacity, right? Because it was the socialists destroyed the place for 40 years. So it's like you basically have this resource where it's very different. You cannot contrast that shale deposit with US shale deposits, right? And so you've got, if you were contrasting, say, both deposits as well as companies within that sector, you got a deposit or deposits in the US where all of the top tier assets have already been drilled. And you have companies now which are valued far higher than a company or companies in Argentina, which are sitting on assets which have not had those top tier assets drilled yet, and massive expansion available. Now, whether that happens or not is a different equation. There's a whole lot of other factors. And then, of course, you've also got the pricing of those particular companies. So all of these things combined, I guess, with the geopolitical realities make it interesting. Certainly if we had a shale deposit that was in Ukraine, it's not quite the same as a shale deposit in Argentina, is it? So, yeah. But I don't know, Brad, what are your thoughts?
Yeah, well, look, like Argentina's been a fantastic, up anywhere between 5 and 10-fold in some of those stocks. Gradually, those things are coming home to roost. All those chickens are coming home to roost. The other thing which is sort of caught our attention is the chickens coming home to roost as such with renewables. We're seeing it here, particularly in Australia. Yeah. And of course the whole and Trump coming in too is just giving the finger sign to the whole climate change thing. Anyway, we'll get onto that later. But yeah, so we've been essentially fed this lie that renewables can achieve net zero by 2050 or something like that. That's just a political thing in the first place. It's been bizarre because even like a sort of half clued up 15-year-old could tell you that these things aren't going to work, and yet we've got all these politicians going down the road and spending goodness knows how much money. But now, especially in Australia, we're having the threats of blackouts because they've taken these coal-fired power stations offline. They haven't been keeping up with the maintenance of them. So the existing coal-fired power plants have been put under immense strain. And there's been quite a few outages, and there's just no backup capacity to absorb any of these big coal-fired power stations going down or coming offline. So we've had the threat of blackouts, and we go back to, last week back in New South Wales. I think the average temperature in Sydney was 33 degrees. And they were telling people to turn off their dishwashers and pool filters and washing machines at night because there was a lack of electricity. And this is all due to this ideology. So this is starting. What's happening now is this starting to come to the fore, and the average person on the street is starting to become very, very aware that, hey, this stuff isn't working. And I've always said that everyone's a greenie until it hurts their pockets. So now the average person's waking up to stuff not working, and politically these clowns in government are coming under immense pressure, and they may well lose the election over it. I think a blackout or two would actually be a very, very good thing. Then people will finally wake up. But that's been helped along by Trump coming in, and he's sort of his whole philosophy of drill, baby, drill, bring back fossil fuels. He's saying the whole climate change thing is a hoax, and everything in it that goes with it. So we're starting to see, in fact, we've been seeing for a while, this whole push to renewables peaking and rolling over. And I imagine we're going to have to find a lot of money to make up for the money that's been lost of all these renewable projects over the last 10 or so years. So we're still very, very confident that our thesis on energy is going to play out. We're doing okay. Been helped along, of course, by Argentina and a few other things in the interim. But we still think that, look, we've said for some time that this things like coal stocks, natural gas stocks, and the like are going to be the new cigarette stocks. Cigarette stocks did exceptional well from the late 1990s for the next 15 years. We think the same thing will apply to the fossil fuel and related stocks over the next 10 or so years.
Right. So
that's what we've been. That's been a big thing that sort of caught our attention. The average person in the street is starting to wake up to this over the last month or so.
So you mentioned the upcoming Trump admin. Any other downstream effects that you guys see from for the next 4 years as we kind of see a shift in policy from the Biden admin to the Trump admin? Chris, do you want to take this one?
There's a lot that they've talked about, so we'll have to see whether it comes to fruition. Some of the things being discussed are really significant. The suggestion that he would pull back all taxes and replace them with tariffs is probably the most extreme of them. I can't think of a stupider thing to do, frankly, but that doesn't matter. Politicians do stupid things all the time. The question is more around whether that does actually transpire or some variation of it. So we'll have, again, it's ordinarily markets start pricing things in advance. I've not yet seen markets begin to start pricing that. I think probably because most asset managers look at it and go, that's so retarded, it's not going to happen. It's probably just political theater. A part of me thinks that probably is what it is. And then a part of me also realizes that there are some suggestions being made where clearly the moving parts for those suggestions are being put into place. So in particular, for example, there's been talk about there's been talk about adding Bitcoin, for example, as a reserve into the government's balance sheet, and that's already happened at a state level. I can't recall which state it was, but it doesn't matter. The point is that there's a continuous move towards that as something that it clearly has already been discussed. I don't think the people that are being put into the administration who are clearly aligned with that viewpoint are being put there just randomly. So I think there's a probability event there that could transpire, which could be positive for that as an asset class. But it goes further than that, right? Because what you're doing there is you're taking on an asset which is completely decentralized. It's almost the antithesis of government, and certainly the antithesis of central banking. So that's largely a finger to the banking cartel. Whether that's, and look, in total aggregate, it's meaningless, right? So the amount of money that they're talking about there, I think they're talking about 200, was it 200,000 Bitcoin a year?
Yeah, and I believe it's only the Bitcoin they've already confiscated, and they already have in
it would be a
possession.
transfer of assets.
Yeah, so they're not going to go out and buy additional Bitcoin.
But it would be that as well as purchase. Yeah, so I have looked into that. I've spoken to a couple of people to try and understand exactly what that looks like. It would be additional purchase. which again would put pressure on the pricing thing. And again, so let's forget about the price for a minute. The total aggregate of that is meaningless with respect to the balance sheet of the US government, or certainly the federal debt. So you go, well, why would you be doing that? What's the mechanism what is it that you're trying to actually achieve? I would, the cynicist in me looks at it and says, well, what they're looking to do is simply legitimize crypto, and Bitcoin is the most well-known crypto, and that's a gateway drug for a central bank digital currency of some description, right? That's the cynic in me. And that would actually make more sense, because again, it's just a token. It's a token purchase, right? Even if the government, I mean, what did the government send to Ukraine this year? Like 40 billion or something. Right. So a few billion into Bitcoin is really just another hotel for Zelensky in France, right? It doesn't really matter. So there's probably a different agenda behind it. So there's that, and then of course, I mean, there's other implications. There's things like within the healthcare space. Of course, we've got Kennedy in there. There's what's his name, Jay? But okay, I'm gonna get his name wrong.
Yeah, the new NIH.
Danford. Yeah. So like, they're filling the administration with people that, these are the conspiracy theorists that were saying the same sort of things that we were saying 4 or 5 years ago, right? And it's clear to me then that your big pharma is going to be that's bear market territory for those guys. I mean, and it's not just big pharma; it's big ag as well. So there's a lot of that sort of, and that's from what we can tell. It's big food, it's big ag, it's big pharma. And so then when you look at all the companies that fit into that space, there are a lot of companies there that could lose their status, or at least lose a lot of the privilege that they currently have. So while we are not typically in our investment fund, we won't short anything. Very, very unusually do we do so, and we wouldn't in this instance either. It's about looking at that and going, okay, there's a lot of capital that's tied up in some of these very large companies. And so what does that look like? Tyco, there's huge food, even Monsanto. I mean, if I was in Monsanto at the moment, I'd be worried, right? Because they are at the tail end of a lot of this, both on the pharmaceutical side as well as on the food product. Like there's an entire value chain, and a lot of it sits within the Monsanto network. So it'll be interesting to see whether there is any traction on that front. I think it would be fantastic if there is. But from our standpoint, where we're currently at, we're not allocated into those sectors now. If we were, I'm pretty sure Brad and I would have been on the phone going, "Hey, we need to lighten up on this stuff." But we're not, right? So it's a non-issue for us. But it's, I guess it's an intellectual question that one could ask oneself as to what does that look like? How does that impact, if at all, the broader market and then other sectors? So, but not to sort of sell your own book, but when I look at, say, the S&P 500 and I look at allocations across it from asset managers, certainly there's huge allocations towards big pharma, big ag, all these companies. And guess which has got the lowest allocation still? Energy, right? So often it's not just it's like, I think it's Howard Marks who talks about second and third order thinking. Like it's not about the first order thinking, saying, oh, okay, Kennedy's in, and there's a bunch of people coming into the administration that are going to be negative towards big pharma in particular. Let's go and short big pharma. Like that trade's already done. Like you should have traded that. If you're going to do that, you needed to trade that, 6 months ago. So it's second order thinking. It's like, what happens after that? What's the consequence of the consequence, sort of thing? So we're quite happy with where we're allocated. I think at this point in time, we've made some other little changes. or are in the process of making those changes. I'm not sure we should delve too much into that now because we haven't sort of finalized it. But there's a number of sectors around the world that are representing value. Certainly, we were talking about this yesterday, Brad. We're looking at Nvidia, and so Nvidia is now almost the same value as the Nikkei index, like one company.
2.5
Trading
trillion.
at what's it, 100 and what's the PE, 100 and
Yeah,
something?
whatever it is,
Um,
it's insane. Yeah. Um,
mm,
yeah. Well, getting back to changes with Trump. I mean, as Chris said, we'll see what happens. But I think a lot of it is a lot of it's not going to transpire the way people think. Like drill, baby, drill. As Chris said, a lot of the best quality assets have already been drilled out in the US.
Mm,
We're already seeing that all the basins outside the Permian Basin rolling over, they're maturing. And the Permian Basin itself is a lot more closer to maturity than everyone thinks, if it's not already, peaking right now. They're probably through 45% of their assets, and particularly tier one assets. So it's going to be very, very difficult to grow production. It's not the US shale patch is a very, very different animal now, rather depleted animal compared to what it was 10 years ago or even 5 years ago. So all the stuff he says, well, sure, you make it easier to drill, take a, in terms of red tape and what have you, but it's not necessarily going to transpire to any additional oil coming out of the ground.
I see.
what you got
So
to remember with this stuff is these are long cycle assets, right? And so you like you don't just run out there and go, okay, we've now got a mandate to drill. Like it requires going out and getting debt financing because it's almost always debt financing. Um,
permitting.
where you've got existing assets, fine. There's a shorter time frame in order to get to actual production, but outside of again, we're already on the tail end of that. So then you look at what else is out there. Well, we've got a lot of offshore out there. That's known. We know what the assets are, but there's still that requires billions of dollars in capital deployment to actually go out and pull it out. So that I think that's kind of one of the more interesting spaces. But it will also require the companies and the CEOs and the board management and subsequently the shareholders to look at this entire political environment and go, okay, we're probably safe for a multi-year time frame politically, and that's questionable. That's questionable. So Trump's got 4 years. What happens after 4 years? It's not clear. So I think, to Brad's point, I think the deployment of capital will surprise people to the underside.
Mm,
In that there's the noise, there's the rhetoric, there's all of the actions, the desires, but when the rubber meets the road, and you've got to pull out capital and you've got to deploy it and know that that capital is at least relatively safe for what has to be longer than a 4 year time frame, right? Because if you started tomorrow, you're probably only going to start getting like drill rigs and everything and all of that out in 3 years if you're lucky, right? So what happens then if you've got a new administration that comes in 4 years' time that goes, oh no, Greta Thunberg's knocking on the door, and we need to go and start eating vegetables and riding our bicycles and wearing
yeah. There's
our
a
hemp
risk of
clothing and
discontinuity. Yeah.
exactly.
So what do rising energy prices portend to confidence in government? You look back in the 1980s when we had, rising interest rates, and people often like to find patterns similar to the days of Volcker and so forth. But a key difference between today and yesteryear was that energy was a lot cheaper back then. You could effectively grow your way through higher interest rates. That doesn't appear to be the case today. So, what are some of the impacts that you guys are seeing as it relates to higher energy prices on governments?
Look, and these are topics we talked about many times before. As energy prices go up, inflation goes up. It's the bedrock to society, right? The bread that gets transported from the bakery to the supermarket to for you to go and pick it up from the supermarket, everything is impacted typically on an inflationary basis as a consequence of higher costs of energy. Okay, whether it be running your air conditioning, transportation, even the products, the synthetic products that come out of energy, at least from oil, everything in our society is tied to that, to the energy markets and to the oil markets in particular. So now, when you have a rising cost of all of these things, the only way to mitigate that is to have a higher productivity that can sort of mitigate that increased cost. And that's not the case, unfortunately, right? Because you can't have higher productivity when you've got such massive debt loads. So now you combine the higher debt load, and in order to keep in order to keep the capital moving within the debt system, so think about debt, it's got to get rolled over. All right. So when you're rolling over debt and you're sitting there going, okay, I can get 4 months on a treasury, 4 points on a treasury. Do I want that if inflation's running at 5, 6, 7%? Right. So the equation starts changing quite quickly which is why we're seeing a lot of demand on the short end of the curve, just because people are happy to have liquidity. There's uncertainty, so they want liquidity. But when you go further out and down the curve, the 20, 30 year, there's very little demand there, which is why they haven't been selling those notes, right? There's no demand for it. So you get into a situation quite quickly whereby it becomes more and more difficult for the governments to finance their operations. And that is a debt crisis and hence a monetary crisis. So, energy is the bedrock to society. It's also the underpinning to an inflationary setup. And as I mentioned before, it's not just inflation, it's actually stagflation. So people often think of inflation about everything going up in price and wages and everything else. No, it's a stagflation environment where the things that you need go up in price, but it doesn't mean your wages go up, at least to the same degree. And you have lower productivity. You have lower productivity because most everything is built on debt and you can't pay back the debt. So we can't pay back the debt anyway. Plus, now you have increased costs of managing that debt. And that's essentially the situation that many governments are in, certainly in Western Europe and in the United States. And historically, if you look at the cycles of these things, this is where governments go to war because they have to justify a debt repudiation. And they're not going to turn around to their citizens and go, sorry, guys, we fucked it up. And you don't get those pensions that you've been paying for 50 years of your working life. And it's gone. That's not palatable. So it's not a surprise that we see geopolitical conflict. Sorry, Brad.
Already, Chris, as an example of how indebted these countries, many countries are, take the US. The US spends as much now on defense as it does on interest repayments.
Right.
So here's a scenario, all right? The underinvestment in oil, or in fact fossil fuels over the last 10 or so years, due to the massive increase in shale, combine that with shale topping out, you have oil prices and fossil fuel prices rise, and we rise a lot more than everyone thinks. So oil back above $100 a barrel next year sometime, whenever. Okay, it was 18 months, whatever. Against a backdrop of heavily indebted countries. So interest rates rise. And this is where things start getting tricky because, countries don't really have the ability to, their debt load, the interest bill already is very, very significant. It's huge. I mean, as I said, the US pays as much on interest repayments now as it does on defense spending. So where this gets to, and it's not just that. There's other little examples. So in Australia, interest rates have climbed back up again. They're nowhere near where they were in the 2000s. I think the sort of mortgage rates, well, okay, the overnight rate in the 2000s in Aussie, sort of late 90s, mid 90s, late 90s, 2000s, and Aussie was about 6%. The overnight rate now is about 4.5%, but already you've got record numbers of households under mortgage stress. Now, if interest rates rise back to sort of like normal levels, what we saw back in the late 90s, 2000s, goodness knows what that's going to look like in terms of mortgage stress. Now, that's just a microcosm of the same thing is happening in Australia and in New Zealand, same sort of things happening in the US. So we've got individuals who are up to their eyeballs in debt. We've got countries which are up to their eyeballs in debt and struggling with interest payments. So then what happens if oil goes $100 a barrel, like up there somewhere? Inflation rises, and with that, the cost of capital rises. This is we don't quite know the consequences of all this. We sort of know how to be positioned for rising fossil fuel prices, but the second order effects are going to be really, really interesting. Yeah, it's almost like full marks to Trump. He'll do some good things, but he's inheriting a heavily indebted government. His hands are somewhat tied, unless they start doing weird things like debt jubilees and things. But I think that would only happen after we've had debt crises. So, and on top of that, look at the equity market. The equity market is dominated by these high growth stocks, these high valuations, tech stocks.
Yep.
Semiconductors, whatever, Nvidias, Teslas, and those valuations, those long-term valuations where you're paying 100 times PE, like of Tesla, they don't take too kindly to the rising cost of capital. Yeah, so if interest rates rise, your discount rate obviously rises. So folks don't value what they think earnings will be out, 10, 20 years. They value more earnings that are here and now. So you will probably have rising oil prices, rising interest rates, rising inflation, and a re-rating or derating of the valuations of these high-growth tech stocks. Perfect recipe for disaster if you're very, very bullish on the S&P 500. Not so bad if you're bullish on those very things that caused the inflation to rise in the first place, which is oil prices, natural gas, coal, etc. That's a sort of scenario. And I hope I've sort of, I'm never very good at explaining things in a rational, succinct way.
Right.
But hopefully you get a fair idea of how things are sort of, how we're positioned, what we're thinking, and this could be heck of a dramatic. Obviously, very, very good for gold prices, but who knows? We and we're bullish on gold. No one really knows. We don't know what asset class is really going to outperform. Now, as Chris said, we bought Argentinian equities late 2021, had a reasonable allocation to them, and that allocation has gone up quite dramatically. Now, we never knew it took a couple of years for it to take off. We never knew it would take off so dramatically. And likewise, looking 5 years out, there's no telling what the price of gold will do relative to oil service stocks, or platinum stocks, or coal miners, etc. But in there's going to be similar gains to be had. So it's actually very exciting times. The hard part, as Tom Petty said, the hard part is the waiting, because sometimes you got to wait a little bit longer, and usually it takes a little bit longer.
Yeah, it sounds like these things are. Go ahead, Chris.
I was just going to say very quickly, the thing that most investors don't want to talk about, and I know it doesn't make for it doesn't make for exciting content or anything else, but it's about portfolio management. And Brad's got this saying, which is setting yourself up to be lucky. And so what you do is you asset allocate across situations which have that asymmetry, right? Like Argentina was back when it was September 21 when we started investing into that, right? So and what I mean by asymmetry was your risk of downside was relatively low. It was already priced largely for bankruptcy. I mean, you had companies trading at like a couple of times PE with strong cash flows. And you're like, what could go worse? Right? Now, it's possible for some of those things to maybe halve. But when you're going and you're putting, say, a 5% allocation into that, you can actually take a 5% halving across 5% of your portfolio. But then you go, what's the upside? Well, the upside is now manifesting itself, and it's clearly a multiple of that. So your risk reward was deeply in your favor. If you build a portfolio with those sorts of setups, and let's say you 5% allocation across those sorts of setups, it's actually quite difficult to go wrong. Your amortized returns over time will beat most anything else that's out there. Which touchwood has been largely what we've been doing. So, but these are things that people don't really want to know about. They want to be like, but Danny, tell me the one stock that I should buy for 2025, and that's the wrong question. It's very much the wrong question. In fact, you might get it right. For the worst thing that can happen to you is that you get it right, because you will then use that as a strategy going forward and you will lose your shirt, guaranteed. And so, and these are lessons that I learned fortunately, when I was 20 something, where I literally did that. And so it's best that you either learn from others or learn from yourself as early as you possibly can, and just don't do that. So asset allocation, portfolio management is actually more important than sitting there and saying, which is the one stock I should buy. That's absolutely the wrong question to have. So it's about trying to look for these setups which are deeply in your favor, and then you can, drip into them, and then you can move more aggressively. And we've done that sometimes into any particular sector where it starts showing itself to be more of what you thought it was. I don't know I think it was Howard Marks who talks about this. He's like, something to the effect that if you wait for all of the information to be in front of you, by the time you have all of that information, then the information will be priced, and that's it. There is no upside. And so, on the other hand, you have to make decisions based on what is somewhat limited information. And so, for what most people do is they wait for validation as opposed to information. So where you've got the information and it clearly reveals to you that you have asymmetry, what we do is we just allocate. We go, okay, we don't know what sort of timing it is, but it makes some sense for us to own this on a relative basis. And you're always looking at competing objectives, competing asset classes, competing equities, competing everything. And so, you can't and won't be invested into everything that might be kind of a shiny object. But so those are valuable things to have. Having competing things to buy is very valuable, because it makes you sharper. You go, well, I really like this, but hey, that looks more interesting. So you start, you don't fall in love with one thing. It's very easy, and I see this a lot. People fall in love with one idea, and then they exclude everything else. Oh, it's just uranium, or it's just gold, or it's just NVIDIA, or whatever. It doesn't really matter what that one thing is. And then they simply look for validation behind the decision that they've already made. You should do the opposite. Once you've made a decision, you should look for reasons why you shouldn't own it. If you can't come up with sufficient reasons why you shouldn't own it, you just keep owning it, and things will probably work out in your favor. So it's almost the opposite of what most people do.
Interesting. Yeah, I mean, I credit a lot of the of my investment knowledge to you guys. You know, I've been a long time subscriber to Capitalist Exploits. You know, I learned your portfolio allocation strategy back in 2020. Being able to take advantage of asymmetry in the sense that you don't have to win each and every game. Just winning, one or two or a small handful of these plays is all you really need to, see some measured growth in your portfolio. I want to bring up a saying. I believe it's from Drunken Miller. He said, "More money is lost preparing for recessions and crashes than from those recessions and crashes to begin with." There is a lot of optimism in the market, but because of the fact that there is such profound optimism, doesn't that create a sense of worry that we may be near a market top? You do see people like Warren Buffett, at a 30% record holding in cash, and things of this nature. So let me ask you guys, when you see the market so overstretched, do you still allocate to your portfolio, or does it not matter at all? It's just a process that you put forward, and over time you just plan to come out ahead?
Well,
There's an important thing.
Yeah.
Sorry, very quickly. When you talk about the market, if you're not invested in what you're calling them, when you're talking about the market, you're talking about basically the S&P 500, the NASDAQ. If you were not invested in those and you look at it and you go, shit, that's scary, does it matter? If you're not invested into it, I would say all of our portfolio, we're not invested into these common themes, into these common narratives around whether it's the Mag 7, NVIDIA, any of the most, anything that you're going to find on CNBC and that. If we're not invested into, we don't typically pay that much attention to it because it's not a risk to us, right? If you're living in on an island completely surrounded by water in a tropical environment, are you really worried about forest fires? No. On the other hand, Australia, in Queensland or something, out in the outback with surrounded by brush in the middle of summer, are you worried about forest fires? Absolutely. So we're not surrounded by the forest fires. We don't have to worry about it. That's the first thing. So yes, there are extreme setups, and we've talked about them repeatedly. But if we're not invested into those, then I don't feel like we have to sit there and be concerned about what happens if NVIDIA comes down. What happens if the Mag 7 come off the boil? What happens if it doesn't need to concern us if we're not invested into it. And the other thing with Buffett is that Buffett has so much capital that he doesn't have the ability to invest into the things that we invest into, or anyone else like us. If you're managing that amount of capital, you have to deploy it into, if you're buying equities, you have to deploy it into large cap equities to get any meaningful allocation, even if you're going in 1%. And so he's in a difficult position insofar as he can't largely invest into a lot of the things that he might otherwise want to invest into. And I'm not going to speak to what is on his mind and what he might want to invest into. But certainly, if I was Buffett and if I had that amount of capital and I knew I couldn't allocate, which I can't, into some of the things that we're invested into, then yeah, I would probably not invest into the big cap stocks and I would rather be in cash. So it doesn't surprise me that he's sitting on a high cash allocation. But you can't, it's apples and pears. If we were fortunate enough to be as rich as Buffett, then fine, we'd have the problem to deal with. Yeah. But we don't, and certainly nobody listening to this is anywhere near that. Even asset managers that have got a few billion under management, it's a non-issue. So, sorry.
Right.
Brad. Yeah.
Brad, did you want to chime in?
Well, yeah, look, I mean, if we can find enough value and enough diverse value, then we'll be fully invested. Which is the case right now. Admittedly, with a high sort of concentration in sort of energy-related industries. But yeah, look, so because we're sort of small, we can afford to look under in nooks and crannies where no one else can really afford to look at, or at least there's no liquidity. So we can go and invest in like $100 million Singaporean oil service stocks, or little niche shipbuilders, etc. Where the big guys can't. I don't think there's any stocks we've got that are actually in the maybe one or two in the S&P 500. If we have got them in the S&P 500, then it's sort of at the tail end. Most of our stocks are like classified as sort of micro cap. They're sort of less than $500 million, and over half, gosh, probably 75% sit outside the US. So going back to, we don't really care too much what happens with the S&P. In fact, it'd be quite nice if we do see it come off, because with a bit of luck, comes off for the reasons we've talked about, and you're going to see a relocation of capital out of the sort of growth stocks and into value stocks, and energy is a value sector now.
What about margin calls?
I think margin calls.
Yeah. Go ahead.
Well, the margin calls don't really affect the things we're in because they've just been so smashed. Some like Argentinian stocks are a little less smashed than what they were before.
What's worth talking about, Brad, is, and so Brad and I had this discussion yesterday, Danny, in our dividend portfolio back in, oh gosh, what was it, a year ago? Maybe a bit longer.
2 years ago? Well,
anyway, so it was post Russia being sanctioned, and then there was a concern that we and clients and everything had with respect to maybe the same thing happening to China. Okay,
right.
Certainly, Trump has been making a whole lot of noises about bad China, naughty China, tariff sanctions, da 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 da. Anyways, in our dividend income portfolio, we had roughly about a 30% allocation towards Hong Kong listed equities. Some of those were mainland China, some weren't, but essentially they were all quote unquote Chinese. Okay. And so we deemed that potentially to be too high a risk in terms of allocations geographically. So we brought the weighting way back down to about 15%. What was interesting is subsequently, China's been one of the most decimated equity markets on the planet. Its investors are very, very bearish. And when I say investors, it's not domestic. It doesn't look like it's domestic investors. It is Western capital, right? Big institutional money. It's your Vanguard, your BlackRocks, your State Streets, your Fidelities, and so on and so forth. And so your medium and certainly your large cap Chinese equities have been sold off hard, very, very hard. The allocations that we had into our dividend income portfolio were all smallish cap stocks, often owned by founders, by possibly retail, but certainly on the institutional side, basically people like us, deep value hunters. And while you had all of these equities getting smashed into whether it was Baidu or Tencent or Alibaba or all of these things down, some of them down 80%, our equities did perfectly fine. In fact, most of them were up. And in large part, it's because of the capital allocations, right? So your institutional Western capital that became afraid of China didn't sell our stocks because they never owned them. So sometimes it's worth also understanding what the makeup of that cap table looks like. And look, there was no reason to sell them anyway. They were very profitable, like printing money. Why would you sell a company that's printing money? It doesn't make any sense.
I own a couple of those stocks, so I know.
And the reason that I say this comes back to your question around, are you worried about a stock market crash? Now, go back to the China pre-crash. You could have said to us, are you worried about a Chinese crash based on, Western capital leaving because it's afraid of tariffs and da-da-da-da-da? And I could have said yes, and yet still been invested into what we were invested into and not given a shit about it, which transpired as the best thing to do. So coming back to your question, are we worried about a stock market crash? yeah, maybe sort of. I don't give it too much thought because I'm not invested in the quote unquote stock market for it to worry me.
Good answer. Well, hey guys, it's been a pleasure. Anything else you want to talk about that we didn't get to before we wrap up?
No, it's just a waiting game, Danny. As I said,
Waiting
waiting
game.
is the hardest part. Yep.
Yep. All right. Well, if you guys enjoyed this broadcast, be sure to give us a like, comment, go capitalist exploits, go in the comment section down below. If you disagreed with anything we had to say, let me know in the comment section as well. I do read the comments, and check out our special discount on the Capitalist Exploits newsletter. It is my favorite newsletter, my newsletter of choice. And for Capitalcosm viewers of this channel, you get a special discount. A link to that is down below, so be sure to check it out. Also, check out our Substack, capitalcosm.substack.com. And with all that said, I'll catch you next episode. Bye, guys.
See you guys.